These past few weeks have been absolutely historical when it's come to the financial market. GameStop has absolutely decimated huge hedge funds, and there's been an almost extreme unity around supporting the stock just to screw over these big hedge funds that shorted it to ridiculous amounts. It wasn't too long ago that the $30 billion Volkswagen short squeeze was referred to as the mother of all squeezes. Tons of hedge funds lost billions and billions of dollars, and huge entire economies were really flipped upside down. This event led to a lot of countries actually banning the practice of short selling. For those of you that don't understand these huge spikes and the ridiculous events that have occurred in the past few weeks and what exactly a short squeeze is, I have a previous video detailing all of this. I'll link it in the description below, and I'll also have a title card in the top corner of the screen. This video is going to focus more on the fallout and actual progression of all of this. And there are also a lot of resources out there online giving you more details about what exactly short selling is and how it works. A lot of huge names have been super critical of short selling, especially with this recent short squeeze on GameStop. Elon Musk is certainly a very potent name with a lot of following that has really criticized short selling. And it does make sense. A lot of these huge short selling terms really attacked his company, Tesla. And when you're short selling a company, you are sort of artificially repressing the price. And when you have a low share price, it's hard to raise capital when it's being artificially forced down. And for many of these companies, if they take a large short position, it's in their interest to really screw a company over. They make money by having a company fail. So a company might be doing well despite having it be more difficult to raise capital. They have a vested interest in that company not doing well. If they're smart, they'll close their positions. But a lot of these companies perhaps engage in shady business practices. When they give an astronomically low price target, or say that Tesla doesn't have any demand, or other things that are just barely on the edge of being a lie and fall into the opinion category, they can give whatever price target or analysis they want as long as they're not directly lying or trying to manipulate the price. The thing is, there's a certain amount of blatant action that actually needs to be associated with what they're saying and doing in order for the SEC to be involved. And sometimes the connections are rather sloppy or not the strongest, but we see tons of these big firms with relation to short sellers that are giving really crazy, ridiculous price targets or perhaps disingenuous or ignorant price analysis. And it begs the question, did they really feel that Tesla was a $30 stock and $80 stock? Or are they giving a very negative view because they want the stock price to go down? Tesla short sellers in particular lost billions and billions of dollars throughout the years. The company persisted despite their best attempts to really have it collapse. And to be fair, Tesla was going through pretty rough times not too long ago. Now, this sounds pretty negative, but when it comes to actual usefulness of short sellers and the value they provide to the market, I'll say my perspective is that they do have a financial incentive to reveal misguided companies that lie to investors, mislead investors, and do other shady actions. Now, obviously, the SEC exists for that, but many times they're not very potent, or they stay out of things, or don't really do their job particularly well. In fact, a lot of times the SEC launches an investigation because of a short seller report that has evidence in it. Probably one of the most famous examples is Hindenburg Research when they released their report on Nikola Motors, which launched an SEC investigation into Nikola Motors. So when a short-selling firm like Hindenburg Research discovers accounting irregularities, bad actors, things like that, they are providing value to shareholders if they're providing the truth. And Hindenburg Research in general does have a fairly good track record. There are some of these short sellers that they say things, they provide information, and sometimes just ask questions, and they're very potent and effective. Obviously, it's a little strange that they make money with a company failing, but if they have legitimate evidence of something, that's really what moves markets. Markets are emotional in the short term, but over the long term, they're logical. Think of the Tesla dips and then steady progression. So when a short seller has a very good track record, they begin to make money not just on the fact that they provide some sort of evidence against the company, but that they have quite a reputation for quality work. So their mark of shame tends to carry a bit of weight. So I wouldn't say that short sellers are all bad or necessarily that it should be banned, but there were certainly some actions in this whole GameStop squeeze that have been absolutely ridiculous. For example, these big hedge funds that were shorting GameStop had absolutely insane positions. They were shorting at like $4 a share, essentially expecting the stock to go to zero. Except GameStop's fundamentals were not that horrendous, and they did bring in new management, new leadership, as well as a new round of funding. This wasn't Lehman Brothers that we were dealing with. It wasn't Enron that we're dealing with. And they shorted the stock to over 140% of the actual shares available in float. Float meaning the available shares not held by insiders or institutions that can't really move them easily. And there's a couple ways this can occur. The most common is that someone sells a share short, and the person who buys that short share also shorts it. So now you have two people that owe 2 shares of a stock, but there's only been one stock that's traded hands. And when it comes to the actual fallout of the whole situation, Robinhood restricted trading on GameStop and other stocks. There were tons of platforms that did all sorts of ridiculous things like forced stop loss positions and other things like that. And the worst thing about it is that when they came out, they essentially said, oh, this is to protect the retail investor. Like, you have your self-directed trading account, but we don't trust you to do self-directed trading. It was a PR nightmare and incredibly stupid of them to do. In fact, now Robinhood is facing a lot of class action lawsuits over that and tons of criticism. But the actual issue is a little more nuanced. There is a lot going on with this whole situation. Robinhood is not a company that clears its own trades. They have this interface and this nice fancy app, but they're not the ones actually executing the trades in person, if you will. The CEO of Webull actually did chime in and explain why this was going on. And you may have seen on your brokerage that certain brokerages were restricting activities or doing other things, or maybe only allowing you to sell the stock. Link in the description below if you want to get started with trading. I'm just going to play a short clip. I highly recommend you watch the whole video if you want a bit more detail on this entire situation. But the CEO does give a pretty good summary.
I was very angry when I got a call at about 10:58 a.m. this morning Eastern Time from our clearing firm, and they informed me that they will not be able to support new opening positions in 3 stocks specifically: GameStop, AMC, and KOSS. Now, after yelling and screaming, this is insane, the reality is this: we need to settle those shares. If you sell a stock of GameStop, you expect to get paid for selling that share of GameStop. And when that action doesn't happen, when you sell your share of GameStop for $350 and you get zero back at settlement, that's a very big issue. Now multiply that by the billions of shares that are exchanging hands in a day for a stock like GameStop, and then you have a situation where you have complete market collapse, right? So to explain it simply, the reason why our clearing firm is not able to support clearance on those specific symbols is simple. We clear through a system called DTC. Back 200 years ago, you would buy a stock and you would pay someone out in front on the Buttonwood tree out on Wall Street in front of where now the New York Stock Exchange sits, and you would hand that person cash and they would give you a stock certificate, a paper stock certificate. We don't deal in stock certificates anymore because it's inefficient. We trade so much volume now, having all that paper obviously does not work. So companies like DTC were started. DTC is the go-to company. They own this business basically. They pretty much have a monopoly. There are alternative ways to settle trades, but DTC settles more than 95% of trades that happen on the street. Now, DTC needs to maintain an orderly marketplace, meaning if you sell a share, you are going to receive payment for those shares. That's what they guarantee. In order to guarantee that, they set collateral rates for custodians, right, or clearing firms. So typically, on a typical day, there is 2 days till settlement. You trade today, you have tomorrow, Friday, and then you have Monday. So the stock will settle on Monday. Those 2 days, meaning Friday, and until the funds actually come and exchange hands, so to speak, someone has to fund that trade. And the clearing firm does that. That's one of their jobs. And typically, there's a collateral of about anywhere from 1% to 3%. So if you were selling a share of Apple, that clearing firm until settlement date would pay 2% of the notional value of that trade to DTC that DTC will hold as collateral until settlement happens. Now, because GameStop, AMC, and KOSS are so volatile, DTC has raised that requirement collateral rate to 100%, meaning that for every single dollar that exchanges hands in those stocks, the clearing firm has to send for deposit for 2 whole business days that exact same amount of the notional of the trade. Now, when we're talking about GameStop at $250, $350, billions of shares trading, we're talking about hundreds of billions of dollars that the clearing firm physically has to send in cash to DTCC to hold there for 2 whole business days. And to be well capitalized, they can't do that. So in order to stop the clearing firm from going out of business, they stop the settlement of those shares, resulting in firms like Webull not being able to allow customers to trade those stocks. Right? It's a market dynamic. And what's going to happen if DTC doesn't move that, right? So we want to blame DTC. We want to say DTC is the bad guy. They're raising requirements to 100%. Well, what happens if they don't do that? Then you have counterparty risk. So if I sold a share of GameStop to someone at $350 and that person was short and covered a short, say that person was Melvin Capital. Melvin Capital is now completely underwater. They don't have enough money to pay for that purchase to cover their short position. So now the clearing firm is going to pay on behalf of Melvin Capital. And then the clearing firm will try to collect that money from Melvin Capital down the line later on. If they don't get it, they mark it as a loss. Now multiply that billions of times. Now the clearing firm can't pay to settle those trades. So you have billions of people that sell stock that aren't able to get capital back for that sale. You have counterparty risk. That means that you have a complete market breakdown. And it's a bigger story than just GameStop. It's the whole market is not able to function.
So all of that is pretty insane. The real issue here is that those clearing firms simply do not have the funds to deal with that. A small company like Robinhood, although it's really ballooned in size, doesn't have the capital on hand to deal with things like that. And they don't want to take on the risk of Melvin Capital going bankrupt. In fact, Melvin Capital last week was bailed out by Citadel with a more than $2 billion bailout from the Citadel hedge fund. It's just kind of gross to see this financial irresponsibility, and to have this screw over the clearinghouses so much, it really does beg the question, should it actually be legal to short float shares over 100%? That's kind of insane, and it led to tons and tons of trading platforms really getting screwed over and crunched. I mean, only being able to sell a stock, that kind of feels like some sort of artificial limitation to force the price down, especially when you're in cahoots with Citadel, a company that has a vested interest in the stock staying down. But they did also have some legitimate reasons for it, so it's a weird balancing act. And this is certainly controversial because Citadel is involved in this entire mess, and they actually buy customer data from Robinhood. One of the things that Robinhood does is they sell your data to hedge funds, which is something a lot of people don't realize. They actually obtain their data from Robinhood in exchange for millions of dollars. And they can use this to see if there's a huge trend or a lot of so-called Robinhood stocks that are pumping and popular with these small retail investors. They want to get in, do a pump and dump, and then get out. And there is a lot of scrutiny from federal regulators because that leaves all those retail traders holding the bag for these hyped stocks that have no substance behind them. But hedge funds can make a killing because they see that they're trading on what is almost a social media app, but for stocks. And this is all really meshed together in the most crazy way possible. And I'm not particularly surprised that a lot of people really gripped onto this and that it spread as far as it did. There are so many people that have gotten into trading recently and gotten into the market. And not just that, but they have been stuck at home. They don't have tons of things to do, so they've been staring at their self-directed trading. There's all these new apps out here with super low trading fees that are very easy to use. Tons and tons of stimulus money has come through with the previous bills passed. So you get tons of young people stuck at home with easy-to-use trading apps and a bunch of stimulus money. A lot of young people who grew up watching their parents go through the 2008 financial crisis. And it really felt like there's always been a good amount of resentment about the 2008 financial crisis. How a lot of people were really not punished for what happened. How there was this huge mess that destroyed the average American's life and that tons of people had to live through or see their parents live through. There's a lot of resentment and hate for these big hedge funds. So there were a lot of retail investors more than happy to jump into something memey and fun to screw over these huge institutions that they feel like have really screwed them over and their families' lives. And I think a lot of the coverage on all of this has been particularly poor. A lot of people are really blaming these small retail investors for messing around with what was publicly available information. It's just that it was condensed into a very memeable, funny form, and it spread like wildfire. And this hedge fund was punished for taking a very dumb decision. I mean, if you make a dumb decision in the market, you lose money. And that should be true for hedge funds as well. And there were tons of questionable articles coming out, things saying Melvin Capital had closed their position on the 27th when the stock was trading at over $340, and while it did take a dip, was still sustaining over $300. I don't think a lot of people were particularly convinced that they completely closed out, but now it does look like they have closed out most, if not all, of their position. There is some talk about other things occurring, maybe a gamma squeeze or more complex issues, but that does seem a little doubtful. Really, it seems more like there was a large bailout and this hedge fund took it on the absolute nose. But other huge hedge funds like Citadel are defending their pets and preventing them from completely dissolving, despite their absolutely astronomical losses. And we have seen tons of pumps on other stocks that were very heavily shorted, but GameStop was by far the worst when it comes to float shares that were short. However, there were a lot of honorable mentions out there like AMC. So if you got to see all of this, well, congratulations on viewing market history. This is definitely something that's going to go down in the textbooks and be talked about for a long, long time, filled with tons and tons of weird analysis. This is a really interesting way to start off the year, and it might be an incredibly strange way to start off in the market. But if you made money, congrats. If you enjoyed watching hedge funds burn, congrats. I know there were a lot of memes out there of people on dramatically different political sides, like Donald Trump Jr. and AOC, both tweeting about how much they hated these stupid hedge funds and how they deserved to lose money. There's a lot of resentment from people across the political spectrum and even the wealth spectrum. I know a lot of people in the financial space who just really can't stand a lot of these hedge funds taking these ridiculous, crazy positions using incredibly high leverages. A lot of this is done with loaned money or other things like that. So, quite a complicated blame game. If you're interested in investing in the market with self-directed trading, a fantastic way to start is with Webull. If you sign up now using my referral link in the description of this video, you'll get 4 free stocks valued up to $3,700. You'll receive 2 free stocks when you open your account, valued between $2.50 to $250 each. And then if you deposit $100 or more, you'll receive 2 more free stocks valued between $800 and $1,600. All the money in your account is yours to invest, trade, or withdraw with as you please. There are 0 fees associated with depositing money. You just get your stocks and you'll get your buying power immediately. So if you want a fantastic mobile, desktop, and web trading brokerage, just use the link in the description below.